Hey folks, Nev here of One Deal Away. And this weekend I ended up doing a special live recording Zoom thing for my students and folks that are over in my Facebook group called Real Estate Investing Secrets. And I ended up covering all kinds of things that are happening in economy, the news, anywhere from Europe all the way to Australia, anything that is happening with our money, meaning the dollar, the currency, talking about the gold, the silver, and of course, getting into some real estate and kind of news that I have been able to gather and information that I believe is important and pertinent to us as we're all trying to figure out what in the world is happening and how do we protect our money and wealth. It is a bit longer form video, but I think it's important to cover a lot of information because in order to be able to be a good, solid investor, to protect our wealth, to protect our investments, to protect the money that we have all been working so hard for, it is important to see a big picture to be able to then chunk it down to information that you need for your particular investment strategy. This is not an investing advice by any means whatsoever. It really is information so that you have more knowledge as to what's going on in the world, in the markets, with the money, and to be able to understand, are we going into inflation or deflation? Because the strategy is going to shift depending on the cycle that we are in. I believe we're going into deflation, potentially depression. Many people have been talking about it as well. I've called it well over a month ago now. And so I want to explain why I believe what I believe and what are the things that you can watch without my guidance, without anybody's guidance, to understand where are we going next. If you like these videos, if you find important information here, make sure you give me thumbs up because it does help with the algorithms pushing the stuff to more people. Make sure you subscribe and click the bell button so that you get notified when new video shows up. Also, make sure you share it with your friends, family, acquaintances on Facebook, LinkedIn, whatever channels you want to share it on, because I do believe that information here is incredibly important. At the end of the video, we kind of ended because I go live and hang out with folks, answer live questions, and that piece won't be part of it because these people are actually paying to hang out with me. So I want to make sure that I honor them by not sharing very personal information that we have shared on that call. If you would like to join and be part of some of these live things, let me know and I'll definitely hook you up. I've done some live stuff over for folks over at Real Estate Investing Secrets, which is a Facebook group. It's free, it's open, so you can join in if you'd like to do that. I figure I share with you some of the stuff of what I have been able to kind of see, and it's happening. So I got to tell you this. Okay. So since the COVID thing, I have been living in hoodies, t-shirts, and pajama and stretch pants. So I am petrified, absolutely petrified when they let us out that I won't have anything to wear because I'm sitting home. I'm not moving as much, although I try. Snacking and eating, cooking, and I'm afraid that I'm just going to like balloon up and none of the clothes are going to fit. But I've been spending a lot of time hanging out, trying to figure out this whole world of technology and streaming and doing all this stuff. So I've been geeking out on a lot of different things, but I want to spend time telling you a little bit about kind of what's going on with news around the world when it comes to money and investing and all this different stuff. So this is the stuff that I actually want to spend time sharing with you today that hopefully you're going to enjoy. And if you're not watching live right now, maybe you will watch at some point in the future. So let's talk about Europe and like what's happening in EU. I don't know if you've heard, if you watched any of the new stuff, but there's this economic feud happening between the North and the South and the Europe, predominantly between Spain and Italy, who, as you know, have been ravaged by coronavirus. And so everything is under shutdown.
They're trying to support their medical stuff, their people, the mortgages, the payments, like similar stuff that I think everybody around the world is experiencing. But because they tend to be a bit slower, lower economic forces within Europe, they're being challenged with the costs and stuff. And then Germany is saying you're not pulling your weight. So they're really going back and forth. And there are some folks looking and saying, is this going to mean that some of the countries will be exiting the European Union? I don't know what the answer is, but we'll only find out. Now, another thing that was interesting that has happened is Poland is dealing with these legal battles, so to speak, and the EU is stepping in and basically saying you have zero legal power even within your own country, and is threatening to fine. So there's this like attack on the sovereign ability to do stuff within your own country, which is really interesting new development that hasn't been happening before. Turkey, unless you have been, living under a rock, they're having a huge currency devaluation, have been having a lot of issues, and I'll actually talk a whole lot more about money that I'm really excited to share with you some of the charts and stuff that I have been able to see. Germany and France entering a deep recession, triple question mark. So economy is in, these are the two largest economies within European Union. France is actually getting ravaged, and I think I actually put that in. The number of COVID-19 keeps going up exponentially, of course, because that's what it does. But their economy has been shrinking by well over 6%, which are the numbers that haven't been seen since the 1945, which is right after the war. And that was the time, if you think about Germany, that Germany was sort of the enemy. And I say this because for some countries it wasn't the enemy, right? But for the United States, for example, it definitely was. And so they had all these reparations and everything else that they had to deal with. So they definitely entered some deep recessions in it. And, questions by the news agencies is, are they entering recession? And I, as I'm sure you already know by now, believe that we are definitely entering a very deep recession around the world, and potentially even a depression. So that's kind of where I am. Let's talk a little bit about money. So this is one of the things that I thought it was really interesting. So MSN posted this thing, I want to say 2 days ago, maybe yesterday, and saying benefits of recession. So I'm like, I got to watch this. And so they were talking benefit of recession is it reduces inflation, which typically would sound really nice, but that's not the battle we're trying to fight. And I'm actually show you in a few different slides as to kind of why I believe that that's not where we are, and sort of why I think we're actually not fighting inflation. We're actually fighting deflation. And so having a recession is not helping in the fight. So bad call, MSN. What do the three countries have in common? I've already tipped this a little bit. Turkey is, and I put it in EU part, even though they're not part of EU, they're very much connected to EU and one of the number one trading partners. But these three countries are experiencing severe currency devaluations. Their currency is dropping. The interest rate in Venezuela keeps going up. And it's not going up from 2% to 5% or 3% to 7%. It went up to 40, 60% and that kind of stuff. So way crazy stuff happening over there. But while their currency was being devalued, their stock market was going up. And so there's some historical components that sometimes you can see that the currency will devalue, and the stock market as valued in that currency can actually continue to go up. So interesting stuff to watch and happen. Gold, I actually have a lot of charts on gold that I'm going to be sharing with you. One of the key things to sort of know and remember is that there's two different markets when it comes to gold. One is the paper gold, which is that spot price thing. The other one is physical gold, and there's some interesting stuff happening with the London gold delivery as well as COMEX. They have way too many contracts, and because it's highly leveraged, small amounts of money controls large amounts of gold, so to speak, in paper terms only. And so a lot of investors that have been holding paper are trying to convert it into physical. And the problem is they don't have it. They never had it, but nobody ever asked. So it didn't really matter, but it matters right now. And so that's kind of what's happening within the gold stuff. Aussie dollar slides down. There's some interesting news happening right now. They're actually calling kids to go back to school. If you're from Australia and you're here, let me know what else is happening over here. I know that their real estate has started slowing down some, and some of the trading, they do a lot of trading with China, which everybody does a lot of trading with China. And I'm going to share some of the stuff when it comes to real estate on that in a little bit. But they've definitely been experiencing COVID-19 mostly through the trade stuff, and then as we switch up in Northern Hemisphere into summer, they switch into winter. Everybody's question is, how will COVID jump over there even more heavily than it has so far? U.S. currency updates. I actually have a whole slew of charts on that, so I'm going to actually go right into that stuff. So I'm going to show you, I want to share with you a definition. I first and foremost believe in education on things that matter. And so definition of M0, M1, M2, M3, and M4 money, and not all countries have all of them. So US actually has stopped tracking M0. So it's M0 and M1, which is basically coins and notes, like stuff that we have. M1 and M2 is that plus short-term deposits. M3 is everything under M2 plus long-term deposits. And then M4 is like everything. So I want to share with you some of the charts. So right over here, let me see if I can. Well, you're just going to see the way that you're going to see it, but hopefully you can see the stuff because I'm going to be sharing some of the things with you. So this is M1 money stock. And right over here, the great stuff is the recessions that we've experienced. So it's like all the way from in the 80s, the 90s, this is the tech crash, this is the real estate boom crash thing. And so money, you can see that it has been chucking. And I want you to pay attention right over here. You can see that puppy like went up through the roof. And here's actually the zoomed in version. So this is April of 2019. So this is basically 1 year chart. And you can see it's been going up. They've been printing money heavily. And it has gone up quite a bit since March, resolutions and executive orders and that kind of stuff. And so anyways, here's M3, which is additional stuff. And what I want to share with you, if you look at, this is in billions of dollars. This is the M2 money stock, right? And you can see that it's 16,000 billion, which is basically 16 trillion. And this one, I mean, this is like, it has so many zeros. I don't even know what to call this. So if you know what it's called, hit it up in chat, let me know, but it's a lot of zeros. So I don't know. Overnight repurchase agreements. This is actually interesting piece. If you have ever heard of the repos, this is what this is. And you've noticed that the repos have been happening like in early 2000s. It kind of stopped mid 2008. You can barely see, there's like a few dots here and there. And then it kind of started going crazy. And it's been, doing all kinds of volatility stuff. Here's some of the swaps that have been happening. So this is a bit of a longer chart because you can see the 2008 and stuff. And then this is the more recent one. And I think, hold on, there's some sort of announcement. One more. Chat. We have somebody in chat. Hello. Oh no, I was live and then it disconnected on Facebook. Well, there goes that. So I tried. Thanks, Sandy. I tried to go live and clearly I don't know what I'm doing. So who knows, right? Your live video has ended. Well, there goes that. I tried, y'all. So anyways, the good news is I'm recording this and hopefully you can actually see it later on. But so anyways, wanted to let's go on and kind of share some of this stuff and then we're going to end it. And then whomever joined the live session here will actually chat live and talk about everything and anything you want to talk about. So velocity of money M2 stock, as you can see, the velocity, this is the part. If you were watching earlier, I told you that MSN has been saying that the benefit of recession, that it fights inflation. And I know that everybody will go in and sort of show these charts to you. And I keep pointing with my fingers, if you can see my finger, which you can't. So you can see this stuff, and everybody will point out that money's being printed, inflation, inflation, inflation. This is how inflation is being tracked. It's the velocity of money. And as velocity goes up, the chance of inflation actually goes up. As velocity starts going down, it's actually deflationary force. And that's why in 2000, when money was printed, we didn't see inflation everybody was expecting. That's why in 2008, when the money was printed, we didn't see as big of an inflation that everybody talked about, because as you can see, all the way from like late 1990s, when we kind of hit this peak, the velocity of money has actually been slowing down. And that's the part of the problem. That's the reason why I keep saying it's going into the deflation. Initial jobless claims, I wanted to show this just in case you haven't seen it. This is from like 1960s, I want to say. As you can see, something very interesting that I want to share here with you in this chart. And, here's where you can find this stuff. So I'm not going to go to the link because, but you can see something interesting over here. So initial jobless claims, these again are recessions. If you look at these recessions, you will notice that the jobless claims actually end up peaking at the end of it. Really look at it. So you can go in, you can click on the graph. So if this is the beginning of the whole thing, and we know the jobless claims actually peak at the end, this is the reason why I was freaked out when I saw this. This is the reason why a lot of people who are analyzing this stuff are freaked out. It's just that most people are not necessarily sharing what they're seeing and why. So trade-weighted US dollar index, one of the things that the Fed and the president have been trying to fight is to keep the dollar low. And they've been doing a good job doing that, since the 2008. And then right around 15, it kind of has gone up. And it has actually been going up, not down. And so if you have been paying attention or listening to that, I think it's called the dollar milkshake theory or whatever it's called, the dollar will actually continue to go up in value. And this is the reason why people are also saying, make sure you have some dollars, make sure you have the treasuries, make sure you have the government issued bonds. This is the reason why, because the value of it is actually going up. It likely won't be happening for forever. And if the velocity of money actually starts picking up, then we will start the value of the dollar starts going down. And that's when we're actually going to start entering inflation and potential hyperinflation. But right now, we are trying to fight deflation. All right, so gold, silver stuff, in case you are interested, since we're talking about money and money everything. So here, the 5-year-old, it's 5-year gold, not 5-year-old, and 5-year silver. One of the interesting things that you will see is that gold actually has been kind of chugging nicely along, even as it being suppressed in the value. But anyways, this is what I was able to pull. And you can see it was from Kiko, so you can just grab it from there as well. You'll also notice something peculiar is happening with silver, which is kind of did the nice little bump, and then it's been trading in channel down, then it went up, and then it dropped down. And so in case you're wondering why people are saying that silver has a high probability of performing or outperforming gold, this is the reason why. And here is the gold to silver ratio chart. Again, the gray areas are the recessions. It's a log chart. And so what it basically means is that distance between 60 and 70, 70 and 80, 80 and 90 and so on is exactly the same. So it tries to compress it so that, otherwise it kind of looks a little bit more skewed. And so it compresses it a little bit. But you will see that the gold to silver ratio is actually like right around 110, which is a bit nutso, because the average over, I don't even know how many 100 years, I have been told that it's about 15 to 30. That's another reason. This is another reason why folks are saying that silver is highly undervalued as it relates to gold, as it relates to everything else. And one of the things to also keep in mind is that silver, it is being mined, although a lot of miners have actually shut down because they're being told as, and refineries as well, they're being told they're non-essential businesses, so they are closed, which means more production is not happening. And a lot of them are actually shut down because it doesn't make sense price-wise to do it. And it's a material that is actually being used in technologies. A lot of the great technologies that we are loving and cherishing are actually being used up, use silver. And so that's another reason why people are talking about silver going up. So dollar and gold chart. So I wanted to showcase this. The dollar is blue, the gold is red. And you will see that they typically have like an inverse ratio kind of happening until right around here, you can actually see. So you can see that they're like, complete opposites. When one is up, the other one is down, and so on. And people have been talking that, and I want to say that this sort of piece is right around 2017, 2018 or so. Don't quote me, please. But one of the interesting pieces that is happening right now is that gold and dollar are going up in value together, which many people didn't think it was possible, but it absolutely is possible. And it just basically showcases that there are certain things that are actually trending together right now. And the reason is because you might have also heard some people talking about the deflationary hyperinflation or hyperinflationary deflation or whatever you want to call it. I actually even did a video on like deflationary inflation, and that's the reason why. In deflation, dollar currency tends to do really well. In inflation, gold actually tends to do really well. And it sounds like we're experiencing a little bit of both. It's just in different markets and different assets. And that's the reason why both of them are going in. Eventually, one will prevail, but only time will tell when that will happen. 100-year Dow to gold ratio. So this is one of those interesting pieces that you might have heard people that are maybe very bullish on gold that are talking about. I've talked about Venezuela and the currency crashing, but their stock prices going up. And so, of course, that's possible because the stocks are repriced in the local currency. So the stocks in the United States are priced in dollars. And so, it is very possible that as you hit inflation or hyperinflation, the stocks will go up through the roof while the currency actually loses purchasing power. And so a lot of people will actually use something like gold, for example, to try to figure out of where the actual price of the Dow is as related to gold. And so what they do is they use it per ounce of gold. And my understanding is that the historical ratio or the sort of healthy market ratio should be right around 1. So 1 share of Dow Industrial to 1 share of gold. And so when you're hearing people repricing gold, repricing ounces of gold, and coming up with some of the numbers, this is mostly how they do it, although it's not the only way. There's other additional pieces, but we're not going to go into that. So Dow to gold ratio, I just wanted to show you kind of like this stuff from like 1700s, just to kind of see how it's been Dow to gold ratio has been kind of going up. And then, as you have a boom and then you have a crash, of course, it goes down and then it kind of goes up and then it crashes and then it kind of goes up. And so it's, again, cyclical like everything else, but you can kind of see that it's been, sort of kind of slowing down. And so whether this is that Dow is not as highly priced or that that the gold actually has gone up in value, and both of them have happened, right? The Dow actually has gone down some. It was at high at like 29 mid-February. It's at 23 now since the rebounds, of 18,000. And gold has also gone up, so that's the reason why you kind of see a little bit of a shift. All right, federal debts. And we're talking all kinds of stuff over here. You probably will feel like you're drinking from a fire hose, but it's recorded. You can pause it and, step away. I I mostly actually want to hang out with people that are here live. But before I do that, I just, I've been geeking out for a lot of the stuff and writing in the book. And so I wanted to share some of the research that I've been doing and things that I look at, mostly to help you so that you can look at stuff when you are kind of trying to understand and decide what you want to do. So federal debt, which is total public debt as percent of gross domestic product, as you can see that this is the 100 is actually the 100% of GDP. As you can see, we are definitely above 100% of GDP. And, we've hit started hitting high numbers in the last recession, that 2008. And it kind of has sort of like started slowing down. As you can see, right, it went up and then it kind of started slowing down. A lot of it came from increase in the interest rate and the quantitative tightening that we've been seeing. However, things started to fall apart, the repo market being one, COVID is not helping. So they had to actually drop the rates. But unfortunately, typically the rates have to be dropped about 4 to 5%. So we've only raised it to about 2.25%. So we've dropped it down to 0, which means we dropped about 2%. So in order to do what typically central banks do during these recessionary periods, they would have to drop it 4%. And if you were to do that in the United States, we would have to go into negative territory, which is the reason why I said don't be surprised if we actually do go into negative territory. And speaking of negative territory, if you have been into bonds, into treasuries, government issued stuff, when the market was actually going down quite a bit, the market actually, the prices of the bonds and treasuries has actually gone up. But I want to say it was a 10-year and maybe 3 months. I could be wrong, but anyways, they dipped into negative territory all on their own. So that was an interesting piece. So here you go, 10-year treasury, constant maturity rate. This is the reason why people have been saying that we have been in the bull market in the bonds. And it's been happening since like 1980s, as you can see. And I know it sounds really counterintuitive to say we've been in a bull market, and then you look at it and you're like, it's going down, Nev. So the yield goes down, the price goes up. And when the price goes up, it's called bull market, even though the yield, meaning how much money you get back for the money that you've invested, goes down. So I know it sounds counterintuitive, but that's kind of how it is. This is one of the coolest things that if you don't know about it, if you've never seen it, if you've never played along with it, you definitely want to check it out. This is the yield curve, and this is the dynamic yield curve. And I actually do want to show you something over here because it is so cool. Obviously, you can go do it on your own. Let's see if this can do it. Clearly, my live thing on Facebook didn't work out, so there goes that. I guess, do I get an A for effort? I tried. I really did try, y'all. Anyways, so this thing you can actually put animate, and it will kind of run through and right here, actually, let me show you. So it will kind of show the flat. It will show the, inversion of the curve. There we go. Where did it go for the inverted curve? All right, let's animate it. So you can see that it's inverted right over here, and typically it inverts about 6 to 18 months prior to the crash. So you can see that it's like, it starts inverting and kind of goes from flat to inverting to flat to inverting and stuff. And then once it drops, it goes super healthy. But look how high the interest rate was. So it was well above 4%. Then kind of, this thing happened. They had to drop it. Then it went kind of, look how, this is healthy, very healthy. Then it kind of gets like silly, and then they have to drop. And then you will see kind of things just dropping here. And this is the reason why people have been saying they've been propping up the markets ever since the crash in 2008, because, we've been sort of stuck in this super low level. You can see right here, this is 2017. So it kind of tries to go up a little bit. It's sort of normal. It's kind of doing funky stuff. It's starting to rise. And all right, let's speed it up a little bit. So it keeps climbing, right? This is that little bit of tightening, little bit of increased stuff, but it starts to kind of flatten out. Even though they call it normal, you can definitely see that it's much flatter. And then we kind of hit a little bit of bump. It gets a little bit of inversion down in this level, right? So it's not completely inverted, but look at this. It's definitely getting inversion, which is why spring of last year, I've done some posts. People have been talking about how it's inverting, and then you can see it. It's sort of still struggling. They keep dropping it, and then you will see do the severe drop. There you go. And then it just went back in. But you can actually, play around with this stuff. All you have to do is, this is basically April 9th. So I just kind of stopped it. Yeah, it's normal, but it's like really low level. And so that's the part that is making it very interesting. All right, cool. Let's go back into, hold on. How do I do this thing? All right. So let's go back into this stuff. So let's talk a little bit about crypto, tech, and free speech. I'm going to go really fast through this stuff because I basically want to hang out with folks that are here. And I want to go into real estate because I so believe in that asset. It's not even funny. But I also tend to believe in tech and free speech and crypto as well. So, one of the things with social platforms, I know most of you already know this. And maybe this is the reason why I'm not going live on Facebook. I don't know. Maybe the universe just didn't want me to do that. But we've been seeing a lot of people reporting a lot of issues when they're trying to report news or different information than what the mainstream media wants you to report. A lot of the mainstream media is connected to large publicly traded companies. And so there's a lot of conflict of interest. And so press should be free, but press kind of has to make money somehow. They're all large corporations. They all publicly trade. And it's conflict of interest for me to tell you, like, hey, this thing is in a big trouble when, I'm kind of part of it, right? So just something for you to be aware of. So we've seen a lot of things that are being taken down, a lot of people that are being blocked, not happening. A lot of the crypto reporting individuals are saying they're being blocked now from Facebook and YouTube. Their channels are being shut down without warning. So again, something to pay attention to. And so, if you're interested in learning about crypto, there's a lot of really cool channels. I'm happy to share some of the channels that I've been watching, some people that are really, really cool. A lot of them are starting to develop their own platforms because they're preparing to be taken away from these channels. So as one of them has said it, and I've said it before as well, you are not a customer of Facebook or YouTube or Instagram or Twitter or any of those things. You and I are a product. And so, every time I go on it, I do it semi-reluctantly. Mostly I do it because I want to connect with people and I understand the power of the social networks. And because there's just no as good of an alternative quite yet that is happening. And I keep hoping it will come. But as one of the really amazing guys that I've been following, Ivan on Tech. So there you go. Here's one of the tips that you can take. I've been talking, and I absolutely agree with him on the same concept, is that no matter where you build it, when it grows so big, the regulators will start going against the company, especially if it's a publicly traded company, which most companies want to do because that's how they actually make a lot of money, is with other people's money. And once that actually ends up happening, they're going to have to start banning free speech. So that's just kind of how it goes. And so we're going to keep erupting into the same stuff. And so that's the reason why I'm starting to build some of my own platforms and why I'm encouraging you to do the same thing for your businesses. All right. So Sweden is going completely cashless and cardless. They're actually installing chips into their arms. I've actually heard Germany is doing the same thing. And it's like chips for like credit cards, keys to the house, key to the starting of the automobile. So you can get these chips and they're about like, I don't know, y'all, like maybe a quarter of an inch big. They're like really tiny. They go under your skin. They just give you access and you can just walk into the store, walk out of the store. Like it sort of knows what you purchased and it just charges you and you can go into like just approach your house, touch the doorknob and lets you in. So anyways, it might be creepy for some of the folks, but I think that that's some of the future. I mean, Sweden has gone cashless quite a few years back. You can actually still get kronas. They're part of EU sort of, but they're not on the euro. You could still get their money, but it's really, really hard. I was in Sweden, gosh, 2, 3 years ago. A lot of things have changed since I visited. So I hear, and even then it was rather difficult to use cash. You had to go to these specialized cash places. Like there's really no ATMs over there. There's like the banks exist, but like the ability to actually go and do exchange of the money or pull the cash. I mean, you really have to try hard, and and I hear that it's actually way worse now. So they're one of them. My understanding is China does something very similar. So does Hong Kong and Singapore. But again, not from those places. I've actually never been to Hong Kong and Singapore. Hope to go someday. So let me know what's the truth, because you live there, you know better. XRP is actually a Ripple cryptocurrency, and Ripple and XRP are not exactly the same. They're actually starting to fork in some sort of way of what they're being done, but there's something interesting happening. They're expanding the reach. Originally, they started and made an agreement with American Express. Now they're actually working with all kinds of big banks that I want to say the Royal Bank of Scotland, Santander, Bank of America has recently sort of hinted that they might be using Ripple's network to do the transactions and payments. So they're not necessarily transacting in XRP, which is the cryptocurrency, but they're using the network to actually do a lot of different things. Ethereum, has had some flash crashes, but it does keep going up. People are using it extensively for smart contracts. More and more companies are starting to build cryptocurrencies of their own. There's actually the IMF is partnering with banks to do what, and they are actually partnering. So IMF, which is International Monetary Fund, is partnering with some of the largest banks around the world to develop a world cryptocurrency. And my understanding is that they're exploring Ripple as one of the potential vehicles. Ethereum is another one. I'm sure that they might be exploring their own homegrown kind of thing. So anyways, there's a lot of development happening, which is the reason why I keep saying that I'm kind of crypto bullish. Bitcoin price has actually gone up nicely. So when we had the crash in February or so, you might have seen the Bitcoin has actually gone down in price from about 10,000 something down to like $3,800. Since then, it actually has broke over the 7,000 level. It was 7,300 yesterday. I want to say dropped down to 69 today. So it's still highly volatile, but I think more people are kind of going back into it. The halving is happening in mid-May, and what basically means is the amount of Bitcoin that is being mined or with the transaction, it's cut in half. That's basically really what it is. So where you could do, I don't know, 10 Bitcoin in an hour, now you can do 5. And the next halving, instead of doing 5, it does 2.5. So it just reduces the amount that is created over time, which is the reason why a lot of people are talking about that it's a deflationary currency. So something really interesting to think about and consider. And then FedCoin has been announced mid-February that there is that the Feds, which is the Central Bank of the United States, but it's a private entity. So something to keep in mind in case you didn't know. They have started announcing the FedCoin and are playing and toying around with the idea of basically allowing citizens to just get money, to borrow money from the Fed. So the Fed is kind of like a bank to the banks, and it looks like they're extending their reach. Now, I don't know why they're doing that. I mean, part of it is obviously I believe that the world is going crypto, so there goes that. But part of it is, I wonder if they're planning that there will be a lot of bank failures. So they figure, well, how do we reach customers? And instead of going and dealing with the whole fiasco of banks, why don't we just create this and then go directly to the consumer? I don't know. That's just like one of my wild guess theories. I have a few different ones, but that's one of them. So I figure I'd share that with you. All right, real estate. Yes, my favorite thing. Let's do this. So there's some interesting stuff happening. At first, when the COVID was kind of happening, there's not been a whole lot happening because real estate is a little bit slower moving stuff. And so, everything that happens typically happens at like paper assets. Obviously it hits paper gold, it hits the currency, it hits the bonds. It hits the cryptos, obviously. I mean, they're volatile all on their own. They don't need any help. And then it hits real estate. So I'm going to go over the word of the street and kind of charts and news. As you can see, there's, agents are being furloughed because, well, obviously people are not kind of coming in. PennyMac is warning that mortgage originators, that forbearance buyback could be coming. And there was actually an idea / request, however you want to call it, to talk a little bit about forbearance, and we're going to be covering that momentarily. So, as you can see, no investor left behind, so let's talk about this stuff. So, forbearance is basically, for a short period of time, you don't have to pay. Typically, at the end, you have to pay lump sum, all right, at the end of that period. I'll explain a little bit more. The deferral is you basically, if you defer the payments and you defer them by, say, a month, and you have 24 months left on your mortgage, they will tack it that month at the end of the 24 months. And so now, instead of having 24 months, you have 25 months to pay. That's the difference. And then loan restructuring basically means is you get brand new loan. So you go in and you refinance. That's kind of what loan restructuring is. Now let's talk forbearance, because that is what predominantly people are offering. So they're saying, yeah, there's breaks for people who cannot afford to pay their mortgage. So let's talk about it, because everybody under the sun is offering forbearance. So I'm going to use an example of kind of what ends up happening. Say this is you have a house, and for the ease of math, we're going to use $1,000 a month. Cool? You get laid off, you get on the phone, you call the mortgager, because that's what they tell you to do, and you say, I need help. And they say, cool, we can do forbearance for up to 1 year, right? You're like, all right. Now, the nice part of what's happening with COVID and the executive order is that typically during forbearance, yeah, they can collect penalties and interest, and it could potentially hit your credit negatively. The nice part is that actually has been suspended, which is quite lovely. But there's problems with it as well. Is that, say that, you need to go into forbearance, and while, they don't charge penalties and all of that stuff, at the end of, say, 10 months, things calm down, you find a job, you go back and say, hey, cool, like I know I owe you $10,000, what can we do? So typically they will say, well, you owe us a lump sum payment, Nev. You didn't pay us for 10 months. We put you in forbearance. Now it's time to pay the $1,000 for those 10 months. So now you owe us $11,000. And would you, want to mail the check, or do you want to do a direct deposit? Neither. I've been unemployed for 10 months. I can't afford to do this, right? So this is the part of, to use the 2008, 2009 popular term of kicking the can down the road. So, because what they're doing is really creating a bigger problem for 6 to 36 months from now, where right now there's nothing happening because you can't evict anybody, you can't foreclose on anybody. Everybody can go into forbearance, people that need it, people that don't need it. And the reason I'm saying, if you don't need it, don't do it. Unless you have this like wild theory that you're going to somehow like triple your money by gambling on some sort of markets, which potentially you could. And, if you end up doing it, awesome, good for you. But if it doesn't, at the end of it, you're going to owe, all of that money that you haven't been paying. And if you say, well, I can't afford it, typically what they'll do is, and even if you read, I just visited PennyMac earlier today, just because I saw their report up on top about the forbearance and stuff, and wanted to see kind of what they were doing. And they're basically also saying the same thing that I'm saying, is that vast majority, all of them actually, are forbearance is the only thing that they're offering. So if you're calling, restructuring might be a better solution, But again, problem with restructuring is you still have to pay it. So instead of paying $1,000, it might be like $800, which if you can't pay it, you can't pay it. So that's kind of where that piece kind of comes in, which is where some of these big problems are coming in. But anyways, so what they're saying is at the end of the whole thing, like when the whole thing happens and you go back to work and this slows down, let's all talk about it. Because right now, what most of them are doing is this. They're offering that 10,000 and they will say, all right, well, we're just going to basically, allow you to pay it over the 12 months, which means that your $1,000 a month plus the 833 and 33 cents, thank you very much, that you owe. So now your mortgage has jumped like 80%, right? I mean, it's crazy. So where, before you were paying maybe $1,000 a month, now you have to pay like close to $2,000 to catch up. That's what most of them are doing, and most people won't be able to do that or afford it unless miraculously in 10 months all of these jobs come back and they all suddenly start paying like, I don't know, twice the amount that they have been paying before, which, I guess it could happen, but I just don't see it, y'all. I just don't see it. So anyways, that's kind of what forbearance means. And, so don't just take it lightly. I mean, obviously, if you have to use it, you have to use it. And I don't know. I mean, I have been sitting and grappling with my own self of like, if the time came, what would I do? Would I do this or not? And, uh, I don't know, maybe I would just so that I can buy time. But I think I would emotionally and intelligently basically have to prepare for a foreclosure and right, like just sort of walking away, which, I hope it doesn't happen, but, if it does, I think the key component here to mention is please don't wrap your net worth with your self-worth, because if you do that, anything that happens with your money could potentially destroy you, right, personally. And no amount of money should make you feel better about yourself, and no amount of money should make you feel worse about yourself. So your self-worth is about who you are as a human being and how you treat others and how caring and amazing and funny and unique and all of those amazing things you are. And then money is just a different thing, right? It's just an ability to be more of who you are. And when you have more money, you can be more of that. And when you have less, cool. You can be a little bit less, but you know what? You've learned some lessons. And, when you have lessons, you can pick right back up where you started way quicker than the first or second time around. So, if it comes, it comes, and that's okay. Just don't tie your self-worth with your net worth. That's it. It's the simplest solution. So maybe that's what you needed to hear, because Lord knows I needed to hear that years ago. All right, 30-year fixed rate mortgage average. As you can see, guys, it has been dropping. And the reason I wanted to show you is right here in the 80s, early 80s, the average rate was well over 18%. Imagine 18% mortgage, y'all. So that's the reason now when I'm like, if you have 5, you're cool, right? Like it's fine. I mean, obviously, if you can get 3.3, which is, I think it was 3.6 only a few weeks ago. I think it's 3.3 right now that is on average. And I still expect it to go down. But before you celebrate too soon, so you can see, it was 3.65 in March 19th, and now it actually down here, I want to say this is 3.3. So it's gone down some. And the reason I said don't celebrate too early is I think the slide is coming. One of the other things that was interesting, really interesting, that I have found is the primary mortgage market survey. So what this does, it kind of compares the 30-year fixed with the 15-year fixed with the ARM. Typically, the ARM, which is where it is, right over here. So the ARM is typically lower than the fixed. But do you see something interesting? The ARM is actually higher than the fixed, which lets me know that the banks are expecting this puppy to keep going down. That's the reason why. So, and then there's a little bit of difference between 15 and 30 here, which is normal. They always do that. So that actually hasn't really changed much of anything. And so that's fine. So anyways, just wanted to share that with you because it's something that, is interesting. Wanted to share that. Consumer Price Index, that's basically, showcasing that the prices have been going up, which, shocker, we all know that. Except right here, you can see that there's a slight little decline, and that's because some of the things have gone down in price, but they've also disappeared from shelves. So there goes that. All right, initial claims continue, record-setting pace. So, we had 1 week of 3.3, we had another one 6.6, then we had 6.9. So altogether, we're about 18, 19 million individuals that have claimed for or filed for unemployment. That means that in 3 weeks, nearly 20 million people lost their jobs, y'all. That's what it means. And it doesn't count like the week that we're like living in right now, because what was reported, I want to say yesterday, is stuff that happened like a week ago. So so there's a lag with this stuff, but this is the stuff that I was saying that's like beyond scary. Okay, rent payment tracker, because some of us are investors, we do own properties. And for everybody hanging out here live, I actually going to send you some of the links and stuff for some webinars in case you're interested to watch them. They're not my webinars, but it's just the stuff that I have found that I thought it was kind of cool, and so happy to share that with you. So anyways, but you can see that, roughly it's like a little bit over 80% in April 2019 of people have paid mortgage. So there's always a percent of people that don't pay, not mortgage, rent, y'all. Rent, sorry. Then it kind of dropped down in March slightly. So March was like 81. I want to say this was like 83, 82, something like that. And then you can see this, like it really went from like slightly above 80 to maybe 70% or so. So this is the part that when the renters no longer can afford to pay, now it has an impact on the owners. And then if the owners cannot pay, then it has an effect onto the mortgage lenders, which is sometimes banks, but most of the times it's not banks. And then that has an effect on banks, which then has an effect on everything. So this is quite bizarre. So here we go, some of the interesting pieces that I wanted to share with you when it comes to real estate. Of course, people are very concerned about the spring housing market slowing down. The number of homes taken off market doubles. So more and more people are choosing not to list their properties. So here's some interesting data that I wanted to share with you that I think you will benefit from. And that is that 59% of buyers are delaying a purchase. So, and that's because of those that are looking to purchase. 63% of them are expecting lower prices. 57% of sellers, so those that want to list, are delaying listings right now. Because, right, like, why would you list it? Who in the world is going to buy? So that's why I said there's a little bit of hold up on the market. And then 72% of those that have listed properties are basically saying, nope, not reducing the price. So as you can see, there's a bit of discrepancy between what the buyers want and what the sellers want. And we'll see. Time will only tell how this is going to play out, which is the reason why I said, just pause for a moment right now. And let's see kind of which end of the spectrum this ends up happening. 66% of realtors are reported closing delays. Another reason why I said just, if you're not in a process, just step aside for a moment. Like, the world is hopefully not going to end. I don't think it's going to end. I'm being silly. But, those homes are not going to go away. So, there's really no rush per se, to a degree. So financing has been the reason for delays, then appraisals, then home inspections, then title searches, and then final walkthroughs. So in case you want to see this, if you're graphically inclined, this is the graph basically representing this stuff over here. Excuse me. So one of the things I did want to say is that, and I honestly taught home builders. I honestly thought that I did this, but maybe I didn't say it. Maybe I just thought about putting it in and then I completely forgot to put it in. But I want to talk about mortgage. So don't let me forget about mortgage. So let me go through all of these slides. We're mostly done, but I want to talk about the home builders because the real estate market is prices and everything else is obviously the buyers and the sellers, but it's also the home builders. If the home builders are not bringing the new homes on the market, then the number of homes actually starts shrinking down, which could potentially start pushing the prices actually even higher up, especially if the population starts going up, right? Supply demand. So let's talk about the home builders' impact. So it's still essential service in all but 5 states, which is lovely to hear. Some of the key issues that the builders are dealing with are building material shortages like lighting fixtures, plumbing fixtures, cabinet fixtures, right? Some of the 54% of the projects are delayed, 7% have been canceled, and unemployment actually for this sector has also risen up to 5.3%. So a share of the building materials imports, as you can see, 31% come from China. As you know, China, and of course this is 2019 data, but this is the best we got. But as you know, China has been shut down for about 2 months. So a lot of what we get in stores here in the United States is the old supplies, and we haven't been able to receive as much of that stuff. Now, I know that some of the shipments can kind of started, but there have been some of the challenges, and so we're closing ports, and so it's a bit of a hot mess right now, which is the reason why I think that short term we might see some of the prices of the current things potentially go up, maybe not, and seeing some additional shortages. So if you are a flipper, for example, and you're going in and trying to fix things, you might be able to get a crew. I don't know, what the price is going to be. So there's that uncertainty piece. But, if you can't get fixtures, then, you're going to have to start getting creative, I guess. So there you go. That's something to keep in mind and keep interesting. And the product price index, as you can see, kind of things have been going up. And right here, I wanted to showcase. So this is, let me see if I can. For some reason, I want to see if I can show this bigger, but you can see the stuff has been going up, but it's kind of like slowing down, so it's not much. And then word on the street, here's the stuff of what I have been able to gather from random people through social and different things of what they're posting. So I wanted to cover that as well. We have been receiving some mixed reports. I'm going to assume that some of them are fibbing, which is a nice way of saying lying. I guess I could have used a different word for that as well. So over 60% have reported issues and delays, which is similar to what the realtors are reporting, if you're paying attention. Over 80% report drastically slow processes and interest, not like interest rates, although that's lower as well, but like a general interest of people wanting to buy, sell, do deals, okay? Internationally, mostly from Asia and Europe, well over 95% have been saying that because of the shutdown, there's simply just no deals, like nothing is happening. And so it's like moratorium. It's like, right, like everything is closed, so nothing is happening. In the US, it's a little bit different. Here are some of the states that I've been able to see. Apparently, Tennessee is doing really well. I don't know if that's true or not, but that's kind of what I've heard. I've heard that a lot of the places, it's basically kind of like everybody's holding on and just waiting to see what happens, which makes sense. And then inside of them, it's just because of stay-at-home orders and executive orders and that kind of stuff. There's really not much movement, and so some stuff, some areas are sharing the prices drop. Washington, it's a faster rate of the prices dropping, but it's not as big of the drop. So the prices started to drop in Washington area for a little while. I want to say maybe a year ago, maybe 18 months. Don't hold me to it, roughly speaking. But anyways, they're seeing higher rates. Vermont is reporting much higher interest from out-of-state investors. And if you know where Vermont is located, which is in New England, you can already guess which cities and citizens from which cities are very interested to buy something in Vermont. Vermont is very rural for my international viewers. It is located in New England, and the two towns that I'm talking about, two states that I'm talking about that people are really interested in, are New York and Massachusetts, which are the two highest hit states in our area, which is that New England. And in the United States, I mean, New York City is just getting decimated from the numbers. So there you go. This is the sort of the news and stuff. And yes, I remembered to do this. So mortgage credit availability tumbles to 5-year low. So one of the things is that while the rates are actually going down, the availability of loans, liquidity, is what's starting to disappear, which is starting to get me to start shifting some of my thoughts and opinions. And now I'm going to stop the share